Multiple assets, one strategy. Last week, the DR setups showed it all. Confirmations, divergences, and lessons you don't want to miss. Let's start with crude oil and recognizing low probability trading conditions in a DR range contraction model. Crude oil futures in its Friday's overnight DR session presented this before any confirmation happened to either direction. The only information you have is that the aftermarket DR session has formed inside the previous day's regular DR session, which is also what I refer to as the DR range contraction model. Price is most likely getting squeezed into one direction before making an explosive move to the other side of the market. The previous day's RDR session highs and lows play a crucial role there. Another information that you already have after the first hour of the overnight DR is that the closing price is slightly lower than the opening price, resulting in a red DR box, and therefore also a higher chance to see a short confirmation. Based on volume imbalances, there are several that you can toggle on and off when needed, and also 3 intraday gap imbalances, which can be helpful as usual. Moments later, an unexpected turn, price confirms longs. It pushes higher, reaching 1.5 standard deviations and retraces back into the defining range, where it starts to show some nice rejections. Would this be a valid entry for you? Technically, you can look for longs, but have to be mindful of the bigger picture and the risks it carries. You have the downside model that's broken, and now the situation shifts toward a DR range expansion model or trumpet-like price action behavior. But there is more information that tells you to be cautious. The previous day's RDR highs have been taken, and this is where the squeeze in a DR range contraction model has most likely finished. Chances are not necessarily high to see an expansion to the overall session highs. You don't want to bet on that probability. With all of that analyzed, would you still feel comfortable trading this setup? Think of trading like chess. If you can read the board one move ahead, you avoid the traps and play with confidence. Price pushes higher, fails to make a new high, and targets the opposite side of the range to confirm a DR false session. This move was kind of obvious, especially with the previous day's RDR lows staying untouched. It was just a matter of time for this to happen. Next, we have the Euro FX futures, where intraday gap imbalances supported multiple session openings. Before moving on to Friday's price action on the Euro FX futures, here's a brief overview of when to better avoid trading any asset that is exposed to the equity market as a DR trader. During these days, you can trade crude oil, for example, as it's not exposed to the equity market. Even though it is a non-farm payroll Friday and you should not trade, the whole week gave great insights. When looking at the whole week's price action, Thursday's aftermarket DR session formed inside the previous day's regular session, also what I refer to as a DR range contraction model. Price is being squeezed into one direction before the explosive move is likely to happen. In this case, the squeeze happened to the downside and price took out Wednesday's RDR lows. Zooming into the Friday's overnight DR session, you get a green DR box, a long confirmation, and all within a forming DR upside model. The highs from the Wednesday RDR haven't been taken yet, which makes it a target to look for, also aligning with the one standard deviation level. What else can help us? Volume and gap imbalances. Intraday gap imbalances paint a clear picture here, even the ones from the previous day, especially from the aftermarket session. Look at all these rejections. The aftermarket session opens and finds support at one of them. The confirmation happens and price respects a previous one before pushing higher. Then the current session opens, finds support at a double intraday gap imbalance, and here we are. Looking very bullish, doesn't it? Zooming into the session, there are also some previous volume imbalances on top of the range, and some of them a little bit deeper. Almost half an hour later, an entry opportunity. Price rejects previous volume imbalances, and this is where you might think about an entry, simply targeting the one standard deviation level for a potential 3R. You already know that price is in a strong upside structure. And there you go. Even though it's not recommended to trade due to non-farm payroll, a great lesson in this week's price action on the Euro FX futures. There is way more things that I teach inside my academy that will never be accessible to the public. Currently, I teach about weekly sequencing and how to forecast weekly price action with a high probability using the DR trading strategy. Trust me, there's stuff nobody talks about. Nasdaq's picture-perfect tick grid divergence. The next price action review is about Nasdaq's Thursday regular DR session. There was one thing that made the whole session worth taking a shot. Based on models, this day didn't really painted a clear picture and both sides of the market were being played across the session. But there were other things that made the regular defining range a session worth trading, and here's why. The regular DR session found support at the previous day's RDR mid before it closed as a green DR box followed by a long confirmation. Following the probabilities, you want to look for longs rather than shorts and use other things to support a trading idea. Just a few sessions earlier, some previous DR levels align with the range. One potential area for a shallow retracement and another one deeper in the range, lining up with the aftermarket session mid as well, which would offer a retirement setup. A few moments later, this retracement unfolds. Would you take this trade here? This retracement uncovers something more, and I also made a video about it on my channel for free. The tick grid indicator reaches the lower extremes, making a lower low, while price is making a higher high. That is a crystal clear divergence in price versus tick, further supporting a long trade idea here. A more aggressive way to place a stop loss would be below the previous DR levels, while you can also place it below the range mid to go the safer way. Both ways offer 3R or more. And there you go, price reaches the 1 standard deviation level and extends even further. And lastly, US dollar Japanese yen's huge cluster of previous DR session levels. Last one for today. Tuesday's aftermarket DR session on the US dollar versus the Japanese yen. Even though I recommend not to trade the aftermarket defining range session because it's the foundation for the day and gives valuable information for both the overnight and regular DR session, it still can be traded, especially with pairs like the US dollar versus the Japanese yen, which tend to have more volatility during the aftermarket trading hours. So obviously there is a green DR box followed by a long confirmation, which on a probability perspective tells us to look for longs. If you zoom out, you find multiple previous DR session levels that align with the current range, which can be helpful for your decision. A lot of them are pretty close to each other, making this whole area a key level to watch. Since there are like 10 over each other, you can use one rectangle that covers all of them and toggle on or off each one separately if needed. 10 minutes after the confirmation, price retraces back into the upper area of multiple DR level. One DR level reveals a clean body rejection. This might be your first entry. Price moves back above the defining range but quickly finds its way back into the potential entry area again. While a potential entry is forming, you can toggle on and off the previously highlighted DR levels separately for extra confirmation. Two of them show some nice rejections, but nonetheless, you have to be mindful of your stop loss placement. Where would you place your stop if entering here and targeting the 1 standard deviation, for example? I give you a little hint. The aftermarket session mid-level should be covered at least. But what else is there pretty obvious? It's the previous DR session level area since its highs and lows are very sensitive. Ideally below that area. The trade, depending on your entry, would look anywhere like this. Solid 3.4R potential. Price reaches the target and extends even further, but look closely where it's rejected sharply from before doing so. It's not only the aftermarket session mid, but also two previous DR session levels that aligned there. Absolutely beautiful. I recommend everyone to re-engineer sessions from your asset that you trade with all the DR basics that I teach. I guarantee you that you will find valuable insights. The DR trading strategy and its algorithmic insights that I teach inside my academy give you everything you need to build a solid trading edge in the market. If you're serious about trading and taking your journey to the next level, then feel free to visit M7DR.com. That's it for today, guys. I hope you enjoyed it, and I see you in the next video.
We're gonna take on the world.